Welcome to the fourth quarterly analyst call of 2012. The changing ESG landscape is the only quarterly analyst call focused on corporate sustainability reporting and sustainable development issues. This is also known as Sdroi Tv, the future of sustainable development television. I'm Dan Sweeney, Director of the Institute for Enterprise Ethics at the Daniels College of Business here on the University of Denver campus. We are delighted to host this call and videocast. These quarterly analyst calls are presented by CRD Analytics and MetaView and are broadcast live from the University of Denver campus. Our technology sponsor is Enablon, and our social media sponsor is CSR Wire. During the next hour, our co-hosts Michael Muyot and Mark Serwinowski will discuss how companies measure, manage, and communicate ESG performance to drive improved operational and financial performance. Michael Muyot is the president and founder of CRD Analytics. Michael is an acknowledged leader in sustainable investing and the designer of the SmartView 360 platform, which powers the Nasdaq CRD Index, the Global 1000 Sustainable Performance Leaders, and the SEC Sustainability Rankings. Mark Serwinowski is the founder and CEO of MetaView Incorporated. Mark is an award-winning advisor, published thought leader, and teacher on sustainable development issues. Mark is also the designer and the award-winning Sustainable Development Diagnostic Tool, which links external ESG frameworks to leading indicators and financial metrics. Our special guest today is Sandy Nessing, Managing Director of Sustainability for American Electric Power. To get us started on the program, I will now turn the agenda over to Mark Serwinowski.
Thank you, Dan. Hi, my name is Mark Serwinowski, founder and president of MetaView. Welcome to our fourth quarterly analyst call of 2012. I'm pleased to introduce you to my co-anchor, Michael Muyot, president of CRD Analytics. Michael, it's good to be back with you, sir.
Mark, good to see you as well. I'm looking forward to today's show. Over the past 3 months, there's been a tremendous amount of activity globally in relation to sustainable development.
Yes, indeed. Over the past quarter, we've closed an election cycle and re-elected President Obama to a second term. We saw Superstorm Sandy devastate New York and New Jersey and henceforth reopen dialogue about climate change and policy. We saw a new carbon market open in California, and in the ESG reporting realm, the landscape continues to change with reporting framework changes released by the Global Reporting Initiative, the International Integrated Reporting Council, and the Sustainability Accounting Standards Board.
We've got a great show planned today. I'd like to invite the audience to join the SDRI community and submit your questions using the hashtag SDROI.
Yes, sir. So, a quick summary of our show today, folks. Over the next hour, we're going to report on and analyze sustainable development issues across the globe, from corporate reporting to sustainable investing and policy and market analysis across the sectors. We're going to focus on climate change, carbon policy in the markets, sustainable investing and the changing landscape of ESG reporting, from frameworks to sustainable indices and rankings. And we're going to drill into the discussion of sustainability reporting and materiality assessments, which drive reporting and operating strategy and, of course, financial outcomes. We're also honored to have a special guest and recognized leader in sustainability reporting, American Electric Power. AEP has been recognized for their transparent disclosure on sustainability and integrated reporting. And we'll be speaking with AEP's Director of Sustainability, Sandy Nessing. So let's get right into it, beginning with our news and analysis. Michael, if you would, sir, please kick it off for us.
What do we know post-Superstorm Sandy? Well, we know that it was the largest storm to ever hit the east coast of the U.S. It stretched 1,100 miles from end to end. We also know that the economic losses total approximately $62 billion. New York is seeking $42 billion in disaster aid, plus $9 billion for projects to head off damage from future storms, and New Jersey is asking for $37 billion, plus an additional $7.4 billion for future projects. This comes from NOAA, government agencies, and the Associated Press. Here's the cover of Bloomberg Businessweek in early November. The issue tackles both the cause and effect of Superstorm Sandy from a very practical perspective. It discusses how Sandy has returned climate change to the national debate, because this is about both economic losses and the losses of human life. German reinsurance company Munich Re issued a report titled Severe Weather in North America. It estimated that weather-related losses totaled over $1 trillion from 1980 to 2011. Thus, extreme weather is not something we can stop overnight, but it is something we can be better prepared for and respond to while long-term solutions are put into place. Mark, over to you.
California's largest greenhouse gas emitting business has paid nearly $10 per metric ton for the right to release carbon in the atmosphere, raising almost $300 million US for the cash-strapped state of California and its energy companies in its first ever carbon permit auction. The permit price was below market expectations, despite strong demand from utility companies, manufacturers, and the oil refineries participating in the auction, according to market sources. Ahead of the California Air Resources Board announcement on November 19th, traders, brokers, and analysts had predicted a clearing price in the range of $11.75 to $12.50 per ton. Here's a quick summary of the California Global Warming Solutions Act, promulgated as California Assembly Bill 32. AB 32 is a cap-and-trade program to reduce greenhouse gas emissions, to be managed by California's Air Resources Board. California is to meet its goal of reducing GHG emissions to 1990 levels by the year 2020. It could achieve an 80% reduction from 1990 levels by 2050 with this program, and under the cap-and-trade, capped sectors and facilities will trade GHG's permits. There have been other regional carbon exchanges in the U.S. market, yet, as we've seen before, California is a bellwether for regulatory and market drivers. This will be an interesting issue to see play out in context of the new administration, yet we've already seen corporations investing on the buy side in terms of credit and on operational investments to innovate their asset infrastructure, something we'll be talking about in more detail during the analysis segment. Michael, back to you.
We are still analyzing the impacts of Rio Plus 20 conference, and as we have talked about before on this show, we clearly see global stock exchanges playing a bigger role in both voluntary and mandatory environmental, social, and governance reporting and disclosure. A core group of 5 stock exchanges representing over 4,600 public companies, specifically the Nasdaq, Brazil, Johannesburg Stock Exchange, Istanbul Stock Exchange, and the Egyptian Exchange, made a commitment to promote long-term sustainable investment in their markets. More recently, the London Exchange announced it will require mandatory carbon reporting in 2013 for its 1,600 listed companies. This must be disclosed in their annual report. They must report on all 6 GHG gases covered by the Kyoto Protocol: CO2, methane, hydrofluorocarbons, nitrous oxide, perfluorocarbons, and sulfur hexafluoride. Additionally, according to KPMG, the Hong Kong Stock Exchange announced that it will make sustainability reporting, also known as environmental, social, and governance reporting, a recommended best practice for listed companies starting from the end of 2012. This has now firmly placed Hong Kong on track to follow the wider, regional, and global trends of increased ESG disclosure.
The International Integrated Reporting Council, IIRC, who is advocating a reporting framework which combines both annual and corporate financial reporting with environmental, social, and governance reporting, has released its most substantive guidance to date. The IIRC, which is comprised of cross-section of global institutions and the Big Four accounting firms, released its guidance which follows a structure of 7 key categories. The combined financial and ESG reporting categories align with GRI and drive an enterprise view of risk and opportunity across 7 categories, including organizational overview and operating context, governance, opportunities and risks, business model, performance and outcomes, and future outlook. Several companies have already adopted the integrated reporting framework, including our guest today on the show, American Electric Power. We'll be looking forward to more information about the program from their perspective.
The GRI released its working draft of the new G4 framework and guidelines. You can download it from their website, globalreporting.org. Here in the U.S., we have seen a 46% increase in the number of reports with a GRI index from 2010 to 2011, according to the Governance and Accountability Institute. The main objectives of the revised G4 framework and guidelines were to be more user-friendly, improve technical quality, harmonize with other standards, improve guidance on identifying material issues, and link with preparing integrated report. Some of the major changes are the discontinuation of application levels, value chain mapping and prioritizing material GRI aspects, better guidance on the disclosure on management approach provided at the aspect level, better consistency with governance frameworks and disclosure on executive compensation, and supply chain disclosure with new and amended disclosures on the supply chain, new definitions of supply chain and supplier, as well as new disclosures on the supply chain, including procurement practice, screening and assessment, as well as remediation. In addition, Guidance is now included on how to apply the supply chain reporting requirements. The G4 guidelines are expected to be released at their upcoming conference in May 2013 in Amsterdam. Mark, back over to you.
Another key reporting framework making progress in development is the Sustainability Accounting Standards Board, SASB. Reported previously on this show, SASB has formally launched in October with sector-specific materiality guidance development. The guidance captures materiality issues across 8 categories. They are business model and innovation, community, customers, employees, environment, leadership and governance, products and services, and supply chain. With development of the guidance focused on sector-specific issues, SASB kicked off the first sector in November with healthcare and pharma. The healthcare industry working group mapping has been completed and is published on their website for use. The materiality categories and guidance, groupings and issues are one of the most comprehensive we've seen to date. And in a related matter, one of the founding members of SASB, Dr. Stephen Lindenberg, of the Initiative for Responsible Investment at the Hauser Center for Nonprofit Organizations at the Harvard Kennedy School, announced the publication of On Materiality and Sustainability, the Value of Disclosure in the Capital Markets. Steve is also co-founder with John Kadovich and Gene Rogers of SASB. An interesting read, the paper is an additive reference to the dialogue on sustainable investing, disclosure, and reporting. Michael, back to you.
A new project called the Global Initiative for Sustainability Ratings, or GEISR, was launched by Ceres and the TELUS Institute to seize an urgent opportunity to create a non-commercial, generally accepted sustainability rating standard that meets the highest standards of technical excellence, independence, and transparency. As we talked about previously on this show, with over 100 different sustainability ratings and rankings, there is a definitive need for more standardization, consolidation, and streamlining to help reach critical mass and larger adoption amongst the 35,000 plus global public companies. If you'd like to read more, there's a paper on the International Finance Corporation website titled Redefining Value, the Future of Corporate Sustainability Ratings, where Dr. Alan White, one of the co-founders of GRI, discusses in depth the purpose, methodologies, strengths, and limitations, and future architecture of sustainability ratings. The student group Divest Harvard made news recently with 72% of Harvard students who voted calling on Harvard to divest its $30.7 billion endowment from the top 200 publicly traded fossil fuel companies and reinvest in socially responsible funds. The group states that they are working with 350.org as part of a larger movement of over 100 college campuses to all divest from fossil fuel companies. According to The Guardian's recent article titled, "Where Can Investors Who Worry About Climate Change Put Their Pensions?" it talks about how Bill McKibben's Do the Math Tour urges divestment for environmentally and socially responsible funds. As many still have holdings of fossil fuel-based companies like Exxon, Hess, Chevron, and Shell due to their steady return on investment dollars over time. The Nasdaq CRD Global Sustainability Index was reconstituted on November 16, 2012, and 7 companies were removed and added. Accenture and Walmart were added for the first time, while the other companies, Chevron, Citi, Pfizer, Petrobras, and Telefonica, were added back in after being removed for various reasons like ESG disclosure and performance. Mark, we've seen after the past 2 reconstitution, the index seems to be performing quite well, with HP down 40% on the year. In addition of some strong performers, QCDR index is beating the 3 major indexes, the Dow, S&P 500, and the Nasdaq Composite for the past 6 months. Now we know many folks out there are never happy to see energy, especially oil and gas companies in sustainability index, and we covered that in our previous news articles. Your thoughts, Doctor?
Well, indeed, Michael, and let's put this in perspective, folks. I think to set a baseline for discussion here, could you perhaps just recap the methodology of the Nasdaq QCRD Sustainability Index?
Right. Well, it's all about math. So it's based on rules-based methodologies and algorithms. We're looking at GRI G3.1 guidelines, over 141 environmental, social, and governance metrics.
So performance, we talk about performance, we talk about the context of ESG, environment, social, governance, performance, plus the financial, right?
Exactly.
So performance over time, that's how the algorithm works. And you know, so when we talk about performance over time, we have to step back from headlines that call out a particular issue to look at the operating performance in a calendar year, past quarterly activities, to look at performance throughout annual plus timeframes. And that's how the context of this index is working.
Exactly. So you see in the articles, they're very passionate about what they're doing, but you have to look beyond just one individual item. And I think a lot of these companies have these legacy issues. So where Chevron bought Texaco, Bank of America bought Countrywide, they're inheriting not just the assets, but also the liabilities. But this is one single item.
Well, it is one single item. It is not just a footnote on the balance sheet. As with most corporations, when they buy the assets, they acquire the liabilities of said acquisition target. In the case of the articles that were discussed previously in the show, the Guardian article, as well as the Green Biz, they were discussing the Ecuador case, in which this is the case where when Chevron acquired Texaco, they acquired their operating assets in the country of Ecuador. Now, Texaco had managed their assets in accordance with the regulatory laws of the country. They had regulatory relief, no further action required legally regarding those assets. And this particular legal case was not undertaken in the courts within the country of Ecuador initially. It was uptaken here in the U.S. and in the state of New York. So very interesting, very complex issue, but you step back from that particular case, here's a company that's managing its history, its legacy through acquisition and managing the risk as well as the opportunity. So the headlines tease out a specific issue, but here's a company that concurrently is managing a global capital budget like the Petrobras, who was also onboarded to the index this time, right? Here's Chevron with some $30+ billion annually in capital investment to explore for energy globally. So, you know, step back from the headlines, dial back into the broader perspective. Here's a company that invests millions of dollars, billions of dollars annually on health, safety, environmental programs, operational excellence, integrating those performance aspects into business planning and operations and financials.
Right. So it's better to look at a holistic picture, not just a single headline. And when we look at large companies like this, I understand the divesting article and what they're trying to do there. And I say it could have an impact, but I don't know what a very large impact it's going to have right off the bat. Let's look at something like IBM, Big Blue. They went from being a large mainframe computer maker, and they started seeing the writing on the wall, and they said they want to be a global solution provider to a smarter planet and smarter city. So they're able to change their footprint and all their resources in a much better way, but also help their clients, both across companies, countries, and cities. I think with the right financial incentives, large energy companies like Chevron could also do the same thing. Would you concur?
Absolutely, and just in a quick history of the last 100 years perhaps, for energy companies exploring for oil and gas, in particular here in the U.S. market, you know, when you look at policy and regulatory and incentives, and you can contrast current position of Chevron because they've published their position on climate change policy, it's available publicly on their website, but you look at they are asking for incentives. Let's be mindful, Michael, this is in the market sense, this is you talk about sustainability in the economic level, this is sustainability of the economic business model. So they're managing their business in the current rules environment. If we're talking about investing in and driving behaviors to invest capital into building the next generation infrastructure, they need to get the rules right, they need to get the incentives aligned with those rules, so the companies like the Chevron and others will invest in that capital platform.
Excellent. Well, we'll continue the conversation on the next segment.
Okay.
So as we talked in the previous segment, the new sustainable model is to be an active participant of change. A good example would be the new Sustainable and Responsible Investment Trends in the U.S. 2012 report by U.S. SIF. $3.74 trillion of AUM are now investing in sustainable and responsible way. This is up 22% from 2010. To put that into perspective, that's the equivalent of the combined GDP of Brazil and Canada. The three ways the report divides the $3.74 trillion is 1, ESG incorporation equal to $3.3 trillion, shareholder resolutions equal to $1.5 trillion, and community investing, $61 billion. Now, Mark, as we've talked about before in numerous segments, this is active investing. Either you're using ESG screening like we do in the Nasdaq index, you're using shareholder resolutions, or you're putting into local community investing. How would you see this, tying this all together, where companies like Chevron, very heavy fossil fuel, but are looking to diversify, how are they going to bridge that gap to the next industrial revolution.
Absolutely, Michael. I mean, first off, impressive numbers, 22% since 2010. That's an onboarding of some significant capital based on some values-based investing, driving behaviors of companies. As to the Chevrons of the world, you know, we need to be mindful of building a bridge to the next industrial revolution. If we think in the future, as we forecast, there's an opportunity to diversify the fuel mix from carbon to renewables, we need to build the infrastructural bridge to get that. So companies like a Chevron and others, they have the institutional knowledge, the capacity to invest, the infrastructure platforms from which to leverage in the marketplace to actually build those bridges towards a new energy infrastructure. We need to recognize that there's a balance, a sort of a tension, if you would, right? Between driving performance, and they are disclosing their performance, and addressing their performance and expectations around environmental and social performance, but also meeting the financial baseline so they can be a growing company who can be available to invest in.
Sounds like a good segue into the next section.
Indeed, building the next bridge. So Michael, let's continue our discussion here about the next industrial revolution in the U.S. We're talking about balancing perspective on regulations and environment. With natural gas at an all-time low, and with the recent International Energy Agency report on forward look of the U.S. energy markets, that the U.S. will be the leading producer of oil and gas by some 2050, as the estimates roll, could all spark an industrial revolution in the U.S. Let's connect the dots on this one. Well, how can that happen?
Well, it is happening. I think if you really look at all the different news segments and you look at the things we were talking about before, it is happening. Just are we going to do it with diversifying fuel? So yes, there's fossil fuels, but there's also energy efficiency, energy conservation. A report just came out from Ceres and Calvert Investments talking about how 2/3 of global Fortune 100 companies are now either doing renewable energy investments, not credits, renewable energy investments, or they're setting carbon reductions. So it is happening, and they're also saying we're not going to wait for the government. We want real financial incentives to keep doing this.
So we talked earlier about companies like the oil and gas sector, where if we get the rules right and lay down the opportunities, those incentives for them to invest in the infrastructure, they're going to build it. That's on the oil and gas side. So, but let's talk about near term. Let's talk about natural gas. Let's talk about fracking as the issue. The hydraulic fracturing issue, which is an environmental performance issue that has been deemed a significant Achilles heel to the industry's ability to extract the resource in the marketplace. Let's talk about that issue.
Again, headlines or reality? The reality is it's going to happen, and in places like Texas, they're used to that, so they understand that. In places like southeast Pennsylvania, no, they're not used to it. Upstate New York, not used to it either. So it depends on the geography, but it's happening.
And we've got, you know, to localize that issue about fracking, we're talking about the issue of drilling horizontally and utilizing water and other chemical additives to extract otherwise trapped gas and oil products. So that is the basis of the IEA's forecast of the U.S. market and energy, that we, through this fracking process, can access additional deposits underground. Now, to your point about those areas where there's new investment, those are communities in which have not been invested in for years. So you have a density issue with urban populations, you got environmental and social performance. As you mentioned earlier, it's all about balance.
Right, and it's the demand. So the fuel source is fueling the demand. What's the demand? Well, building. Manufacturing is coming back. Industry is coming back. If you're going to renovate something in Detroit to make these new diesel engines, is that building going to be renovated in a green way? I think so.
It creates an opportunity for a spend. You look at the LEED certification schemes for green buildings. It drives investment regionally, economically speaking. It creates a pull-through for new products and services from existing companies. So it's a demand pull. So we're looking at creating a new opportunity, a new infrastructure. And we need to build the infrastructure to utilize that cheaper energy source.
And with that new industrial revolution that's going on in those communities, they're going to be doing it. So what are they going to also need? High-paying jobs. Those high-paying jobs are going to give them more affordability so they can buy better cars and better houses, and they're going to need also the services and infrastructure around that. I really see a new industrial revolution.
I would agree. I would love to see some of the macroeconomic models reforecast to look at the labor cost basis, because going back 15, 20 years, NAFTA, otherwise Asian markets, where labor was the basis for moving production offshore, do we now bring production back onshore, or even recognizing while we in the U.S. have one of the most highly intellectual labor forces, the cost of energy, while the labor cost may be still higher economically, right? So isn't there a balance? Are we bringing the cost of energy down? So is there going to be a rush into the U.S. for industrial production?
Well, I think especially with the election being over, If you get the rules right, you put the financial incentives to, one, bring some jobs back, but also do it from the ground up here. But I think there's untapped new jobs around energy efficiency, energy conservation. So those megawatts could completely offset a lot of that demand for fossil fuels. So again, rules as opposed to blame and shame.
Well, and we're going to talk later in the show with American Electric Power, one of the utilities, like many of the U.S. investor-owned utilities who are investing in energy efficiency programs. And we'll get into the details later, but one aspect is that's the only sector, utility, electric generation and distribution, that has as its business model an incentive to sell less of its product. So you talk about getting rules right. You talk about establishing incentives for the basis of investing in to build this capital infrastructure for the next generation of energy. These are all the different dots that need to align between public policy, regulatory, environmental and social performance, and of course on the investment side of the markets.
And tying back one more huge point, what did we say at the beginning? What we started off with? Superstorm Sandy put this all back on the table in a big way. And we all know after a disaster, unfortunately, there's a huge rise in construction and spending, so all this Northeast that was destroyed is going to be built back up. And what do they want to do? They want to do it in a more clean and renewable way, and they want to put in proper measures to not just help prevent it, but also prepare for those disasters and the response rates.
You know, we talk about reporting, we talk about stakeholder engagement, and these are all different individual stakeholder perspectives, and we have to get a debate on the table in the regulatory and public policy space to talk about these issues in a balanced point of view. If we want low gas prices at the pump, we have to understand there's some impact on the environmental side. What is the risk? Is it calculated? Yes. Is it understood? Yes. Do you want the right companies at the table investing in that? Absolutely. But we need to understand the trade-offs. And as a community globally, we talk about sustainable development. We need to put all these issues into context and make informed decisions.
Well, I couldn't agree more. I couldn't agree more.
So, Michael, let's put these issues into context of corporate reporting and disclosure. We're both excited to have special guest Sandy Nessing from American Electric Power with us today. When we profile all the stakeholder feedback in our global community, one of the top issues that surfaces across all the sectors for all the types of companies relates to corporate sustainability reporting and materiality assessments. We've got the GRI G4 framework out for review, which of course advocates a wider boundary on a company's reporting, which essentially means including value chain and supply chain, which likely drives the most common question we've heard. What is the value of reporting and what's the ROI? Let's discuss reporting materiality. We've mentioned GRI and SASB and integrated reporting today. So let's go to the street and ask a corporate perspective on reporting and materiality assessments. It's time to bring in Sandy Nessing into our discussion. Hi, Sandy. Welcome to the show. We're delighted to have you join us today to share your sustainability story from AEP. You know, Sandy, AEP is viewed as a leader in the U.S. electric utility industry with almost 7 years reporting on sustainability and 3 integrated reports. Could you talk about the value to both internal and external stakeholders?
Sure. The value of integrated reporting for all stakeholders is the holistic view of the company it provides that ties together the inherent linkages between financial and non-financial performance. It's not an either-or. Non-financial performance hinges on our ability to earn a fair return on investments, to have affordable access to capital, and to meet all of our obligations. The level of transparency that this approach fosters allows our stakeholders to better understand what we can and cannot do and why. We're looking at these issues through a different lens now. We consider the risks, financial implications, and governance issues as key inputs to our reporting. As a regulated electric utility, it's one thing to say that AEP supports energy efficiency, but to do so means we have to be allowed to recover program costs and net lost revenue, for example. Without these financial guarantees and absent a mandate, energy efficiency would go nowhere in spite of the environmental and operational benefits from not producing kilowatts.
Indeed, and you know, the utility sector is the only business model where companies are incentivized to sell less of its product or service. So, Sandy, we've noticed your printed reports getting leaner and your online web reporting presence getting more robust. Do you think this is a trend or a paradigm shift?
Well, I think it's both a trend and a paradigm shift. As we move towards an increasingly digital society, the immediate access to information on demand becomes more and more important, and it's expected. Online reporting provides more flexibility for reporters and report users. We can update the information more frequently, while users have access to that data that they want and that they need when they want it. You don't have to wait for the next report to come out to know what's changed in the business environment and how the company is managing it. For example, AEP just debuted an iPad app that's a great summary of key performance data. The beauty of it is that we can update it anytime. That means users can get real data in real time. But having said that, I still believe there's a value in having a print report. People receive information in different ways. The internet may work really well for me, but not for you. There's really no right or wrong way to do this, but there's no doubt that printed reports are getting shorter and shorter, and most of the information is being pushed to the web.
Hi, Sandy. This year, AEP has undertaken the process of conducting a rigorous materiality assessment and stakeholder survey. Can you tell us about this and how it's helped AEP craft its reporting, operations, and communication strategy?
Well, AEP chose to conduct a formal materiality assessment and stakeholder survey this year because the place where we started this journey nearly 7 years ago is not the same environment we live and operate in today. Although we test our material issues with stakeholders every year, we wanted to know how relevant some of those issues were compared to others in light of the changing landscape. 7 years ago, the issues were pretty straightforward: aging workforce, climate change, compliance, performance, energy efficiency, and the future of coal, among others. While these issues are still relevant and important, the landscape around us is very different, and how we address these issues has changed. The future of coal, for example, is largely being driven by environmental regulations. Back then, we were talking about building new coal plants and investing in carbon capture and storage technology to address CO2 emissions. Today, new EPA regulations are prompting the retirement of older coal units, and in some cases prematurely. At the same time, low natural gas prices have led to greater fuel diversity for power generation, and these lower natural gas prices have made it uneconomic to retrofit some coal units with pollution controls as we had originally planned so many years ago. We need to adapt to these changes, and that naturally extends to our reporting. Having a solid materiality assessment with input from internal and external stakeholders is helping us to zoom in on those issues that are most important to AEP, to our stakeholders, and to ensure that the issues we're reporting on are aligned with the material risks of the company. It also helps us to ensure that we're using our resources most efficiently. Early results are indicating a nearly 50% response rate, which is really phenomenal. This is real qualitative input into our reporting priorities, and we'll begin implementing that starting in 2013.
Near real-time reporting, fantastic. And can you tell us, tell the audience about the team you've assembled for this project, Sandy?
Oh, of course. In the spirit of true transparent disclosure, we have engaged with CRD and MetaView to support us with materiality assessment and reporting strategy, and it's been a great relationship.
So, Sandy, AEP has a recognized very active investor relations department. How are they using sustainable development topics to stress its competitive advantages in the utility industry?
It boils down to business strategy and executing on that strategy. Because sustainability development topics are simply part of the way that we do business, we don't specifically refer to the topics as sustainable development. When we talk about generation and transmission investment, we continually discuss the strength of our engineers in problem solving and in developing new ways to do things. In fact, a recent McKinsey repositioning study done here at AEP in our generation business unit has brought to light some significant operational improvements at one of our plants in Ohio that will be rolled out to other plants across the fleet. We talked about these developments in nearly every investor meeting we conducted at the EEI Financial Conference back in November. Clearly, these measures keep us sustainable, but we don't refer to them in that regard when addressing investors.
Sandy, with 400 plus consecutive quarters of dividends, AEP is seen as a benchmark value stock. What are some things investors need to know about AEP's ability to continue to be profitable?
Well, this is a real source of pride for AEP. Our focus on rewarding our shareholders is a hallmark of AEP and its management team. The commitment to the dividend, both by management and the board of directors, is unquestionable. As it relates to continued profitability and earnings growth, one only need look at actions that were taken both in 2010 and this year to see that management is fully committed to delivering that earnings growth to investors. So back in 2010, when it was evident that the power markets were not recovering as quickly as forecasted, management took some action to reduce O&M spending through staff reductions. In 2012, when we got an unfavorable regulatory decision in Ohio, and again the weak power markets indicated that revenues would be less than forecasted, management took action with a repositioning study to find sustainable O&M cuts through process and resource changes. These actions demonstrate that without a doubt, management's desire and its ability to meet its commitments to investors is strong.
Sandy, in regards to AEP's business model and innovation, what are some partnerships that will allow AEP to find new ways to outperform?
Well, effective partnerships are critical to business success. For example, we've built and continue to build upon a culture of grid reliability and compliance. We're in that business. As reliability standards have become more numerous, more complex, and constantly evolving, our ability to comply with those standards depends on the relationships we have with the regulators as much as it does the controls that we have in place inside our business. We have a core team that meets weekly to review standards and controls and to vet issues. They also regularly engage with our regulators and reliability auditors on the outside to keep open lines of communication and ensure that we understand and comply with the rules that protect that bulk power system. Consequently, AEP is often asked to weigh in on the standard setting process and is credited with securing extensions for compliance with environmental regulations, specifically the MATS or Mercury rule, to ensure the reliability of the system is not compromised during compliance with new EPA rules. So for AEP, this builds on ongoing awareness of compliance within the organization, results in continuous improvement, and builds strong relationships with our very diverse and many stakeholders.
Fantastic, Sandy. You know, and folks, as we've heard here today, the AEP story on sustainability reporting and the value in integrated reporting process, there seems to be a high level of engagement across the House regards the value in reporting and the linkage to operating and customer strategy. The future of reporting is here. Sandy, thank you so much for your time to be with us on the show today.
My pleasure. Thank you.
Sandy, thank you so much for coming on the show, and your answers were spot on. I mean, really insightful. Really appreciate you coming on. Thank you.
Fantastic. That's a wrap for our show, Doctor. Another fantastic show this quarter. Folks in our global community, thank you so much, and please do remember, Michael and I will be available for 1 hour after today's show to answer questions in the social community. So you can use hashtag SDROI for a tweet, or the SDROI@metaview.com for the email exchange. We're looking forward to sharing and continuing the conversation online. And with that, I'd like to hand the baton back to Dr. Daniel Sweeney.
That concludes this fourth quarterly analyst call for 2012. Special thanks to our special guest, Sandy Nessing from AEP, and to our stalwart co-hosts, Michael Muyot and Mark Serwinowski. And thanks to all of you on the line and on the web for joining us this morning. The next quarterly analyst call will be held on March 14th, 2013. For more information on the QAC, to share feedback or view content from this show or previous shows, please go to www.thechangingesglandscape.com. I'm Dan Sweeney, and we thank you for joining us this morning.